Today is Monday, December 12th. Tomorrow is CPI, and the day after that is FOMC. And as a result, people are expecting a ton of volatility. And you can see that reflected on your screen here. Now, this is the term structure for the S&P 500, which is essentially just showing us the at-the-money implied volatility for every expiration in time. In other words, how much movement are traders pricing in? And as you can see, these first two data points, the expirations over the next 2 days, we got about a 40% implied volatility, which suggests that traders are looking for 2.5% moves. Now, those are giant expectations. And that means if you're long options, particularly short-dated options, options that expire this week, you need really big movement in order to get those options to pay off. And that is kind of an uphill battle, because if Powell does anything other than really freak the market out with a cut or an excessive hike, then you may not get that much movement. That volatility may come down, and that can really crush your options prices. Let's just give you an example of how. So what we've done here is we plotted two options, right? At the top is a 4,100 call, and at the bottom is a 3,800 put. Both expire in 4 days, and we used the current level of implied volatility for these options, so it's roughly 40. Now, here's where the S&P currently is, and all we did to reprice the option between the blue line and the red line is we just shifted implied volatility from 40 to 20. So that's the only change. And you can see where you maybe bought this option or own this 4,100 call at roughly 15 bucks. If we take the vol from 40 down to 20, the value of that put gets crushed, right? Because suddenly traders are no longer expecting 2.5% moves out of the market. They're looking for something more in line, more reasonable. And that means that even if the market starts to rally here, you're really fighting an uphill battle. Now, conversely, look at the put side. It's the same thing. If you think that the market is going to tank tomorrow, you really need it to tank in order to get these puts to pay off. And in all likelihood, if the market starts to slide lower, implied volatility could come down, and you could end up losing even if directionally you're right, because that implied volatility comes down. The expectations of how much people think the market could move could drop. And then further, if you advance time a couple of days, which is what we did for the green line, you could see you pretty much lose all hope in either scenario. And so that's why when implied volatility is super high like this, it gets very difficult to be long these options, because you really need multiple sort of standard deviation event in this scenario to get those options to pay off. And so that is the challenge. It doesn't mean it can't happen. It just means you're facing this kind of uphill battle in this scenario. Now, if it turns out that Powell does freak the market out and you get either a giant move to the upside or a giant move to the downside, and implied vol goes from 40 to 80, well then yeah, you could end up the big winner. But again, you really need Powell to upset expectations to get those options to pay off. So we hope this helps you look at these upcoming events in a different lens. If you have any questions on this, please put them in the comment section below. We'd love it if you hit subscribe or come check us out at SpotGamma.com.